Welcome, I'm Catherine Magaña here with Rachel Ivanovich, Vince Stefano, and Steve Wolff, where we're here to provide you insights on the markets, tax planning, and much more. Today is March 12th, 2026, and here we are. We have the Iran war still causing disruptions in the oil markets, and the markets are fluctuating. Year to date, as of yesterday's close, March 11th, the Dow Jones, the NASDAQ, and the S&P were all down. The only one that was actually up as of yesterday was the Russell 2000, which was at 2.46. But after today, we'll see what happens because we'll just have to, we might just be flat after today with that index, but the markets are fluctuating a little bit today. But anything can happen because the last few times I've seen the markets fluctuate, there's times we're down and we end up positive for the day. So, but we are definitely in some negative territory right now with some of the indexes. And we've had some conversations with clients recently, and sometimes we hear, oh, this is different. And we're, with crisis and events, and it's interesting because we've seen many wars, we've seen many elections, we've seen tariffs, we've seen it all. And while you feel like this is isolated and it's different, the reality is there's always something that's going to happen in the markets and it's going to fluctuate.
One of the things that I hear a lot is there's way more volatility now than there is at any other time. And the funny thing is that is not at all true. We're about where we were at the beginning of the year right now. So we were up maybe 2 or 3%, and now we're about even on the in the indices. So it may feel that way, especially because when you hear all the headlines and we're now at war, or I guess we're in an incursion or whatever President Trump says we're in. But at any rate, it sure seems like war when you're bombing people. At any rate, this is all about oil. That's the one thing that is up right now. Oil's up. Vince, do you know where it is right now?
It was 97 a barrel when I walked out of my office.
Right. I wonder how that compares to how much we pay for water. And the reason I say that is because I actually think that a bottle of water is more expensive than a gallon of gas.
There might be some truth to that.
It could be. Yeah, you go, hey, Petco Park, you buy a bottle of water, it's $10. So, yeah, there you go.
But it's interesting because you have to refine and do all sorts of things with water. You pretty much just have to put it in a sanitized bottle and send it out. So
the things we'll pay for these days.
That's amazing. Yeah. And then you can recycle.
But that thing about the volatility is interesting because I know, Catherine, you and I sat in on a couple of meetings here this week, and you have a chart. I don't know if you have it with you, but you had a chart that shows that every year that the markets, most years, on average, can go down 10 to 20% at some time during the year. Matter of fact, what was it last year that we were down? I think it was in April.
19%. So last year in 2025, I do have the chart. We were down at one point 19% in the S&P 500, and then we ended up positive 16%. So that was almost a 35% move in 1 year. And if you go back and look at the last 40 years, you'll see it's pretty common where the markets are moving 10, 20, 30, 40% in a year, and it could end up positive or negative that year, but there is definitely some market movement.
And when you say it's different this year, we have had war before
yes.
where this exact same thing happened. And of course, when you're going through the war, obviously everything looks terrible because nobody wants to have war. But this is not something that's new.
Yeah. I think the thing that comes up sometimes is if you, for those that are phasing into retirement or just retired, sometimes there's a little, people get a little nervous, and that's why you have to go back to what's the plan, what kind of income do you have coming in, and so obviously, what's your allocation and what are your cash needs, and obviously if that's been planned out and we've worked with you on that, then yes, the markets are going to fluctuate, but you shouldn't be jumping in and out completely, but yes, are we making some subtle changes along the way? And that the answer is yes.
And really, it is normal to be afraid. As a matter of fact, the CNN Fear and Greed Index right now is just touching into extreme fear.
I saw that. It's like, oh man, here we are.
What's the number?
24, and 0 to 25 is extreme fear. Last week, we didn't mention it, but last week we were at 35, which was smack in the middle of fear. Now we're in extreme fear, which is the lowest it goes or most extreme. But I've seen that index down in the single digits at 4, 5, and 6. So we're not quite there yet. But it's not surprising. I mean, people are, there's a lot of things that you can get upset about and get fearful about. Certainly the market was already a little bit weak prior to what has just happened over the last couple of weeks because the AI Technology stocks, a lot of them were overvalued. They've been moving down. So the indices were starting to move down a little bit. And this just has exacerbated it. And it's a scary time of being in the market. But please, don't let that fear overcome your brain. Don't let emotions rule your investing.
And Steve, it's interesting. I was looking back about 2 weeks ago, we were at neutral. And then last week we were at fear. And then you said we were extreme fear. So it's interesting pretty quickly how the markets move. And
in this particular case, this is all about oil. And it's all about the Strait of Hormuz, which right now we can't get boats to go through there to get oil or anything else, because the Iranians are using drone technology, which is kind of interesting too, and that could actually be a whole nother topic.
I just saw the headline yesterday, the West Coast needs to be afraid of drones. I'm like, here we are sitting ducks on the West Coast.
Well, but what I was going to say is that I think the way we are fighting wars is changing.
Yes.
And this is really, Ukraine, Russia started, to the new type of warfare, and I think drone technology is where we're going to fight wars. It's not going to be with big ships and big planes, all of that might be part of it, but it's going to be somebody in a command center using AI to control drones. And then you're going to have anti-drone systems. And that, I really do believe, is the way war is going to be fought in the future. It's being fought that way now.
So just a couple other items that have come up over the last week. So the probability of a rate cut is pretty much slim to zero. But I did see that the potential for 2 rate cuts have now changed from 85% probability to 35% probability. So obviously,
is that for the year?
For the year, yes.
Well, and we talked about this last week, when you have oil that's going up to $100 a barrel and maybe more, that is making everything more expensive. So as inflation goes up, it has a big effect on everything.
And speaking of inflation, it came in for February at 2.4, so it's similar to January. But obviously that came in before all this other chaos came into play, so we'll see where it comes up for next month.
Although, can I just say something? Yeah. Usually if inflation goes up, you'd want to take the rates down. Yeah. But because of what's happening with oil, GDP is going down. So I don't know what they're going to end up doing, but it seems to me, at least at the moment, that the argument for rate cuts is not there. Maybe when this war ends, it will come back again. But right now, I don't see it.
I agree.
Well, a few weeks ago, we talked about the market being subject to event risk, and that's exactly what we're seeing right now. Every headline, every tweet coming out of the White House is moving this market up or down significantly. I don't know when all this is going to end, but I know it will end. And just some things, everybody gets incredibly negative, and you got to kind of also look longer term and say, okay, positive side. You had mentioned the Strait of Hormuz. Well, eventually the Strait of Hormuz is going to reopen. We're going to get shipping back through. Oil prices will retreat. They probably will go back to $50 a barrel once this is all over. And that's when investors will start refocusing on fundamentals instead of headlines. And according to many market analysts, we could be in for an extreme stock market rally. And I could see that happening because when you looked at Q1 earnings, they were solid across the board. I mean, these companies had really good earnings. Secondly, rate cuts. You had mentioned rate cuts, but not, I have seen where it could be a little higher than, I think you said 30%?
35%.
35%. Yeah. I thought I saw something a little higher, but maybe that's changed over the course. But if that happens, that's good. Conference calls, you had mentioned technology names. Many of these technology names in the conference calls, number one, talked about monetizing AI investments starting in the second half of 2026, number one. Number two, AI is not putting them out of business. In fact, they are now starting to adjust to AI very nicely by partnering with a number of AI companies to enhance their product portfolios.
Are you talking about the software
I'm talking
companies?
about software, chips, everything. Everything across the technology spectrum is now understanding how AI is working, and they're working within their companies to enhance their product portfolios, which I think is very, very positive. You had touched, and I was going to mention it, technology valuations have been compressed dramatically over the past 3 or 4 months. So now you've got incredibly innovative companies trading at 22 to 24 times, but
instead of 80
times. But now where the S&P is growing at 15 or 16 times, these guys are growing at 40 times. So technology names are starting once again to look very, very attractive in this marketplace. And I don't want to be totally Pollyanna because I don't know how long this is going to last, but it will end. And when it does end, the big macro funds, the big hedge funds, the big institutional investors are going to go back to the most innovative companies in the marketplace. And those are going to be the top 20 or 30 companies out there. And they're going to be the majority of tech companies. And like last April, when technology brought us out of the market doldrums, they will once again lead us into a rip-your-face-off rally. I've seen it before. It's happened so many times. You've mentioned it a number of times, and you just mentioned it again today, where this thing can rally dramatically once oil retreats. And that's what is going to happen. So, again, don't get too over nervous about where the markets are going short term. Continue to focus on the long term and look at the best companies out there that you want to be invested in. So again, I'm trying to put a little positive spin on this for the longer term. And I think you really need to start looking at companies that you want to invest in and say, hey, here's my list. Once this gets closer to an end, here's where I want to be.
Yeah, I think this is the time that if you do have cash, you start looking at companies that you want to invest in, because they have gotten a lot cheaper. I don't know if the software companies will come back as much as some of the others. They might. I don't know. Those are the ones that are beginning to hit the most because they think that the AI business is going to limit what the software companies can do. But I think you made a good point. AI is, first it was hailed as being this great thing, and now it's kind of like the Satan, And I think you have to look at AI as a tool to use, and it will displace some people. As a matter of fact, I think that's what's happening right now. You have some companies that are firing people, and yet their efficiency is higher than ever. Okay, and which is one of the reasons I think why a lot of these companies are doing so well on their bottom line.
Right, the productivity is increasing dramatically, and they're laying off, hundreds, sometimes thousands of employees because they're able to utilize productivity from the technology standpoint to increase their top and bottom line. So, yeah, you're absolutely correct on that. And again, you have to look 18 months to 2 years down the road from here and say, hey, where do we want to be? Where do I want to be invested? And I want to be invested in innovation. That's where I want to be because, AI is going to change everybody's life. And right now, people are saying, if you want to backhoe, AI is not going to give it to you. But, those aren't the fastest growing companies in the marketplace.
But you know what? AI is in that backhoe.
Yeah, it is. Yeah, the technology.
We've got some clients who are farmers. And, I go into their tractors, and this is nicer than the nicest car I've ever seen. And it's got more technology in there than you can believe. I always wondered, how before they had AI and before they had what, the Garmins and whatever those things are, the
GPS.
Yeah, the GPS systems. How did they have those cornrows that were so straight? But with these, seriously, they just have to sit in the tractor and let it go. It's amazing. So they've become so much more productive in the field.
It's interesting. We've been having conversations with some clients, and for some clients that are in retirement age, they don't want the market to fluctuate with the markets and have the risk of some of the volatility in these stocks. They're like, we want steady growth and income. We're okay not getting the double digits or whatever those returns are. We're okay having steady. So once again, while yes, we want growth and we want to participate, but when you kind of have to also look at the client, what are we trying to accomplish with their portfolio and investments?
It has to be appropriate for every client.
Because there are some clients
But if you're going to be in the stock market, and we do that. Yeah. You have a diversified portfolio. You're going to have stocks. You might have bonds. You might have some other things. But if you're going to look at your stocks in part of your portfolio, there's no getting around it. It's going to be volatile forever. It always has been and always will. And don't let that be something that stops you from being invested. I think that's the worst thing you can do. And one of the other thing, too, about people who are retiring, as we've talked about before, the biggest mistake that people make when they retire, the number one mistake, is they get to be too conservative. They say, oh, I can't lose any money. And what ends up happening is that they're not making enough money to keep up with inflation and taxes. So you do need all of it, all right? And yeah, it can be a steadier approach. If all you're going to do is invest in technology, then you're going to have a really, really volatile time frame. And we don't recommend that to anybody.
So some other conversations we've had over the last few weeks, and I know, Rachel, we were just sharing that you've had this conversation too, is we've been having some clients ask about Medicare planning and IRMA. And so as some clients are phasing into retirement, they're thinking about, when I go into retirement, what are my costs going to be for medical and the IRMA? And one of the things that just came up was, well, I'm making all this money and this income now. Are they going to look back those last 2 years?
I will jump in there and talk about this. The IRMA, you've mentioned it now twice,
Yes.
stands for the Income-Related Monthly Adjustment Amount, and it's essentially a surcharge on your Medicare premiums if your income gets too high. It's a tax, and there are 34 more days of tax season. But let's talk a little bit about the Income-Related Monthly Adjustment Amount and how and what that means. And there is a waiver for that, and we'll jump into that for a second. But so in essence, there's a table, just like the tax tables, that you have to look at if you are on Medicare of how much your premiums are going to be. And if your income goes up above a certain amount, you're going to pay an additional amount in addition to the base premiums. And there's, I don't know, like 6 different levels of this IRMA they have to look at. But Medicare looks at your income 2 years back. So if all of a sudden you have some sort of an income spike in a year, you may get hit with this surcharge for a couple of years, but then it may eventually go back down. But if you have a life-changing event, then you can file the SSA 44 waiver, and it's found on the Social Security Administration's website. You can download the form, and you can fax it in if you have a fax. Who has a fax anymore? Or you can take it to the office, or you can upload the form. So you can file this waiver if, let's say, you retire, if you got married, if you got divorced, if you lost a spouse. Maybe you sold a rental property, and then in the years following, 1 year you're going to have this huge spike of potentially income, but then you'll lose that rental income. So maybe your income will go down from there. So you can file this waiver if you just have a one-time, let's say you do a Roth conversion and your income's high for 1 year. That is not considered a life-changing event, unfortunately. So the waiver won't apply to you in that situation. But I've been talking to a lot of clients about tax planning and IRMA planning as we're finishing up their tax returns. And that's, definitely something to be looking at if you are thinking about doing Roth conversions, or, doing a rollover from a 401k maybe. And then all of a sudden you say, well, I'm looking at my required minimum distributions that are down the line. I want to minimize the amount. I want to do some conversions. You don't have to convert your entire account. You can convert smaller amounts and just keep yourself under the next IRMA surcharge level. So that's definitely a planning opportunity for you.
So when you have these events, you have to let Social Security know this?
Yes.
And it doesn't guarantee, though, that you're going to be paying less. Is that correct?
That is correct.
Just depends on your income?
It depends on your income. So but look at the waiver. If you go online, you really clearly can see what the different levels are, and you can see where the cutoff is. And it's not a trying to think, it's not a cliff, it's a plateau basically. So if you go $1 over, then you get hit by the next higher premium. So you definitely want to watch that if you're close to the next.
You may not know the answer to this. You probably don't.
Probably don't.
But do you have any idea where this originated, the IRMA charge, why this is in place?
Good grief.
Well, the why,
No
I'm
idea.
sure, is...
Okay, next week's podcast.
Well, I'm sure the
I'll look it
why
up.
is that the government wants more of your money.
Well, that's what I was going to say,
But-
but that was a bad answer.
But I wonder, who thinks of this stuff? This is my weekly rant against taxes.
You can't make this
A
stuff
tax
up.
lawyer, probably. Who knows?
Congress?
Some guy in Congress who's a lawyer who's decided
So
to
you're not paying enough for your health care, so now they want to charge you more.
charge you more.
Yeah. What can I say? I don't know. Just do tax planning and financial planning.
Yes.
All right. What else?
Get your list together because, again, this will end. and make sure that you have a really good list of high quality companies and be ready to invest.
You know what else will end? This particular podcast. As a matter of fact, we're going to end it right now because there's nothing else going on. So until next week, when we'll find out if the war is going to continue or not. Until next week, happy investing, everybody.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.